Hello YouTubers, welcome back to the Independent Investor. This is the weekly market update for November 11th. And again, this is not financial advice, it's just commentary on my own thoughts on the market and some of the investments that I did over the week. This week was a little bit more interesting than the last few, where the market had just continued to float up. This week we saw a little bit more volatility, especially on Thursday, and the markets overall actually had their worst week since last September, and there was quite a bit of trading on the junk bond side, which I will get to a little bit later on. And we can see also the NASDAQ still continues to, as I've been saying, float up, but with a little bit more volatility, and it did actually come down a bit last week. But I have noticed the Russell, which I talked about in previous, being in a trading range, and then it kind of gained ground and caught up with the NASDAQ. But last week we did notice it actually over the last week or two since October started to actually trade down. So the Russell 2000 is a wider section of the market, and typically at the end of a bull market the markets can narrow and you get fewer and fewer stocks that are driving the market up, and that might be starting to show that now. One thing that I've mentioned again over the last week or two is interest rates. We know the Fed will probably increase rates one more time in December, and what we're starting to get is a flattening yield curve. It's not inverted, it's just flattened, and that can be a sign of a slowing economy. And when it actually inverts, what that means is typically your treasury bills will be like 13 weeks, 1 year, 2 year, 3 year, 5 year, 10 year, and typically if you put the time period of the bond on the x-axis with the 30-year bond out here, and say the 13-week here, of 1, 3, and 5, the normal curve would be sloping upwards. Because along the maturity, there's a big risk on interest rates. For example, if interest rates increase, the bond volatility can be very high. Plus, that money you're not going to receive for a longer period of time. So the curve has a tendency to slope up. And an inverted yield curve, which is quite rare, but has a very good track record of forecasting recessions, and that would be where your short-term treasury yields are higher than your 30-year or 10-year. And so we're starting to see the short-term rates come up because of the tightening, and I've got a graph here actually that shows this. So we can see here the 13-week, and that's mainly because of the Fed tightening. It's accelerated quite a bit, and the 5-year has actually increased. We hit the bottom in 2012, but we've noticed on the longer term, which is the 30-year and the 10-year, these two here are actually kind of trending down. So we're getting a convergence. And actually on the 10-year Treasury note has a very good track record of projecting overall economic growth. So if the 10-year stabilizes out at a certain interest rate, that's usually giving a pretty good signal that's where the economy has been growing at and is growing at. So if you have the long-term rate coming down outside of the influence of the Fed, and now the Fed's buying less bonds, you're probably starting to see the market's anticipation of what the economy is going to grow at. And that would be, right now we're seeing about 2.5%. And that could go low. And if this trend continues and we get down even lower below 2, that could be a warning that the future economic growth may not be quite as strong. And in relationship to where the markets are right now, because we're at all-time highs, there's going to be a big disparity, and the markets, if the economy slows down, that means the earnings are going to have to will start to decrease, and so on. So again, I'm starting to move. I did move more to cash last week. I actually opened up some outright short puts on companies that I think are overvalued and will come down, and I'll talk about some of those a little bit later. I also read, this is quite interesting, I have a spreadsheet I use for tracking the overall market conditions, and I keep adding to it when I find new information and some of my own, and I update it kind of on a quarterly basis to get my own view of where the market is in valuation. I've mentioned this before. It's my kind of my bull bear kind of indicator, which has been kind of around the 50% mark for a while now, and I've said that's more because of the momentum and technicals in the market, not the valuations. The valuations are on the very high side. And there's one thing, all investments are from discounted cash flows. So you say if a company has $1 in earnings, and then the next year, say it grows by 10%, and it has 1.1 or $1.10, the next year after that another 10%, $1.21. You add those all up, but each one you divide by the discount rate, and that discount rate can be the 10-year treasury and so forth. And because interest rates have gone so low, that denominator has been lower, which has made the future cash flows higher. And in this article from Mr. Hussman, he's saying that we should not be actually using the lower interest rates as a factor so much, because the lower interest rates, as I was just saying, might actually be projecting a slower economy, and that means the earnings of the denominator, instead of being, say, 10%, might only be 5 or 6, and it's kind of a wash. So the markets might be, there is a Fed model that uses that, the lower, and that does happen to some degree, but it might just been being overemphasized. So, and basically, we know in the States, the demographic, as people get older, there's less people coming into the workforce. So really, any gains, especially in the economy, is a combination of the workforce and productivity increase. And productivity has actually been decreasing. And there's different theories on why that is. A lot of companies, they have intangibles that they have to kind of maybe write off quicker because of the change in rapid change in technology. But it's not disputed that it is quite a bit lower. I mean, we've gone from 2% post-war productivity, and now we're down to about 0.6. So this, again, that's quite substantial. So that being said, there's also quite a few shocks on the junk bond side last week. There was some very high volatility trading in the junk bonds. I actually opened up a long put position on JNK, betting that it is going to decrease. And we can see here, junk bonds trade very closely with stocks because they're very sensitive to like earnings, and they are riskier debts. So we can even see here HYG is an ETF for high yield bonds, and back in 2009 we can see how the correlation was almost 1-to-1 between the index and the ETF junk bond. And we saw that last week. That's what shook the market a little bit. We can see this dip here on the high yield bond ETF. So this might be meaning investors are starting to get a little bit concerned about, are these companies going to be able to pay back their debt and pay the interest rate on these high yield bonds. And we've also seen the yields, so the riskier the investment, the higher the interest rate should be, because there's a higher chance that A, the company could go bankrupt, B, they might not be able to make interest payments. But the spread between the safest, like a treasury, and corporate yields has actually compressed to a very low point, because more and more people are hunting for yield, so more and more people are willing to take more risk.